Kyle, you're a former NFL player. Nick, former fighter. Let's start there. What'd you guys do? Tell us about your backgrounds. Pre-fund.
A pre-fun, I'll give you the elevator pitch version here. Former NFL player, bounced around for 4 years, had a cup of coffee with the Cardinals, Patriots, Browns, and Raiders. Came out of my football career, got a job in sales, running a sports apparel company. I was an SVP of sales for. We are an OEM manufacturer. We are an equipment manufacturer in the sports space. Took and grew that company from a few $100,000 in revenue to over 20 million in 4 years. Essentially got recruited away from that role into a role with Comcast. I led their Comcast started and launched a sports tech venture capital program in 2020. Great time to launch a new program. It was in the works way before COVID. And it was actually supposed to start, I believe, like April 1st of 2020. Wow. And so, long story short, obviously we didn't start then. The program got delayed a year, but then we got up and running, and I've been involved with that program from basically inception to 2024, where I was still on board for the full year, helping run and build the program. But I was basically introduced to CVP early in 2024. One thing led to another, and they asked me if I'd want to join what they're doing, and it worked out that way. So that's the very mundane, fast version. But I onboarded with CVP in the middle of 2024 last year. I've been here now for I think nine months or 10 months, and it's been phenomenal.
So let's go back. The NFL though, like you said the Cardinals.
Yep. Patriots, Browns, Raiders.
Wow.
What was your experience like there?
Well, I'll say this. I'll say that there's a reason why certain teams win and certain teams don't. I'll put it that way. So organizationally, I mean, I had a good experience with all the teams. I also had a bad experience with all the teams because they all essentially fired me at one point, right? So, you know, I would obviously say I was with the Patriots in 2014. I didn't get a ring, but I was with them that year when they did get a ring. But how Belichick is as a coach, as a leader, how Brady is in the locker room, like yeah, you don't get to have as much fun in New England, they would say, but I would argue that winning multiple championships over and over again is pretty fun.
Yeah.
And so, you know, to each their own. I love New England. I loved Arizona. I was there with Bruce Arians in his first year, new staff. Obviously, he then went on to Tampa and won the ring with Brady. But he had a background. He was with Peyton Manning. He was with Ben Roethlisberger. So the offenses with the Steelers and the Colts, that was all Bruce Arians. And then he came to Arizona, first year, new GM, new coaches, new staff, Carson Palmer, Larry Fitzgerald.
Yeah.
I loved Arizona. Like from a location standpoint, living in Arizona, living in Phoenix, outside of Tempe is amazing. It's gorgeous out there. So I would say like overall, Arizona was my first year, and that was pretty memorable. Being with the Patriots was pretty memorable. Unfortunately, the Browns and the Raiders, those 2 years, not so much.
A little rough.
I was with the Browns with Johnny Manziel when he was in, and that obviously didn't go well. Kyle Shanahan was our offensive coordinator. Doug Marrone was head coach. I was in the Raiders with Dennis Allen, who got fired. Also, Derek Carr, Khalil Mack was just drafted. Like, well, good teams, again, poor leadership, and yeah. So that was kind of my experience. A lot of fun, learned a lot, made a lot of connections. A lot of, you know, we were just at the Super Bowl this past week, and there were NFLPA events, and Nick was there, and Marcus Colston, who's one of our other founders of our fund. He's obviously a 10-year NFL veteran, Super Bowl winner with the Saints, yada yada. But you know, I can walk around New Orleans and I run into former players that know me, and you know, I might have been with a team for 6 weeks, and I still have relationships with guys there. So I've really prided myself on building and maintaining relationships through my football career, and it's echoing into the business world.
That's really cool.
I love it. Nick, let's kick it over to your end. Tell us about your fighting background in pre CVP.
So I actually was a college football player and tore the ACL and that killed the dream. And, it's funny, hindsight's 2020, right? But I'm under 6', 205. But you couldn't have told me when I was in college that I wasn't going to play in the league, but I'm too damn small. I was just a fast, angry corner, that ran and hit hard. But I tore my ACL. That kind of killed what I was going to do in football. You really quickly, you lose everything. Your scholarship, your connections. I mean, it just is cut off one day. Yeah. And during my woe is me period, it was actually my old wrestling coach in high school. So I grew up in Minnesota and was a wrestler. And I was a wrestler since I was an ankle biter, so we're talking 6 years old and up. And, he reached out to me. He's like, hey, have you ever thought about trying MMA? And I'm like, no, I have not thought of that. I don't, it's one thing to hit somebody with pads on. It's a whole other thing to get punched in the face. I wanted nothing to do with that. He's like, no, right, trust me, it'll be fun. Come to one practice. And so I went to one practice just to see how it would go. And I mean, I kid you not, it's literally like Fight Club, just like the movie. Like I'm hooked. I'm like, oh my God, can I go next? This is awesome. And so I stuck with it, and it was a hell of a lot of fun. So ended up doing it for just shy of a 10-year career. Had good successful runs in both Brazilian Jiu-Jitsu on its own as well as MMA. Did one Muay Thai fight that did not go good. Don't recommend that to anybody unless you really like getting kicked in the face, because it happened a lot. Ended up kind of at my peak. I did it for a while. This is, I guess, kind of aging me on this side of it. This is kind of pre-consolidation for the UFC. So, I was in King of the Cage and some of those circuits that went around for a long time. There was the Pride Rules, WEC, and that whole conglomerate, and kind of made it there. And during that time, I guess at my top, so I fought at 145, and I got to be in the top 100 of my weight class, and then ended up taking 5th at Worlds in Brazilian Jiu-Jitsu in 2013. And then swan song of the career, and off I went into more of the business side.
That's amazing. That's really cool. That's a cool background. I actually was a judo guy back in the judo and jiu-jitsu.
Okay.
And I always used to, wrestlers never wanted to get on their back, right? Fight on their back was a big problem. We had to get them over.
It's a really hard transition, especially in jiu-jitsu, to go from like being on your back, like never on your back, to then being comfortable on it. So, I mean, the obvious solution is just take top mount and don't be on your freaking back. If you strike somebody on top, it doesn't matter. You don't have to have that problem.
That's right. That's really cool. Well, that's a cool transition, man. That's obviously both of your backgrounds really interesting to go from where you obviously building relationships and we're at in sports and fighting, and then going into this world of investing and finance is pretty unique, I would say.
What's funny is it seems to come across as unique, but you have to transition out of sport, whether that's you're giving your body to NFL like Kyle, or you're getting punched in the face. You can't do it forever, right? So you have to find a way to transition out of sport. And so
unless you're Mike Tyson.
Yeah, right. But the lot for us is, to work in the business of sport. So, both of us, we kind of dabbled in business. For me, I kind of transitioned out working in physiology and more of that bridge between sport medicine and athletic. Kyle did more of the direct business angle, but it kind of all came back to the same epicenter where we joined up in CVP.
Excellent.
Which I actually have my degree in kinesiology, exercise science, and I do absolutely nothing with it. So that's good.
You're not alone.
There's a lot of people, obviously.
I'm glad I actually tried in college for absolutely no reason. So, here we are.
Things get degrees, Kyle. We're good.
I even have my degrrie it's somewhere in storage in a bin somewhere because my mom.
you don't have it on your bedroom wall like the rest of us. Yeah.
I got a Patriots ball and a ball signed by Steve Smith. I got a ball signed by Peyton Manning. That's like cool shit to me.
There you go.
For those who can't see my room, I got Derek Zoolander on my wall, so it's the really, really good looking. So I keep thinking of that, the transition between punch in the face to, being really, really good looking.
That's cool. So I guess going from where you guys are background to CVP, I guess, what was that transition? What did that look like? What was the background there?
For me, it was easy because what I was doing with Comcast in the sports tech space was, I would say, basically a dialed down version of what CVP is doing. It was basically Comcast fund. They had capital to deploy. We would run basically the operations management team of this fund, and we would search the globe for companies and due diligence on them, and pick 10 out of 2,000 applicants. We pick 10 a year. We invest in those, bring them in for 6 months, develop them, grow them, scale them, and then bring them to all of Comcast partners, right? And basically CVP is the same thing, just on steroids. It's true private equity. There's a bunch of different verticals that I'm sure we'll get into, but for me, it was basically the same model that Comcast is essentially doing. We're just doing it as we're the owners and operators, right? So we're the funders and the operators, where CVP has the capital and the hold co. We have a management co inside that I lead, and we basically find companies ourselves. We do all the diligence, we deploy them, and then we can bring them to Comcast if they want. But there's obviously we can bring them anywhere. We can do whatever we want with them. Comcast it's a great program, and you can look it up. I encourage people, especially early stage companies, to look at it. But because they have the firepower of the broadcast networks, right? So they have NBC, they have all these contracts with PGA, NASCAR, WWE, Premier League. So they have the client on the other end. But with that comes a lot of red tape and handle. Like, they're a publicly traded company, so there's rules, regulation. Like, there's a lot of red tape that goes into a lot of this stuff. Whereas CVP, we still have all the regulations of SEC and compliance and all that fun stuff, but we have very few limits on what we can go after. Anything sports related, sports adjacent, sports asset, different levels of companies, different stages of companies. We can write different size checks. We can get equity, different equity options. So it allows us to be more flexible, which to me opens more doors, more opportunities. And so it's basically the same thing I've been doing, just at a much bigger scale, which, I'm thankful for the opportunity I had at Comcast, because I learned a lot. It taught me a lot to be able to execute at a high level here at CVP.
There's a couple ways we could take this, but I want to start with the structure of the fund. So I know one of the unique things about your fund is that it's open to retail and non-accredited investors. Let's start with the structure. How'd you choose the structure, and kind of what is the structure?
So, what's interesting is the way that we did this is, I'll even take a step back and say, when we first designed CVP, we knew we wanted to really work with athletes first, because as all of us as being athletes and having that background, you find out really quick. And people always think that athletes are able to get into these deals, or able to, deploy capital and see cool things. It's actually the exact opposite. Athletes have been left out of the room for their entire careers. What they see is these super risky deals that their family, their friends, their mom say, hey, you should do this. I got a friend that's racing here. I'm doing this, and this. And the bottom line is, it's just the stuff that's never going to take off. And so these high risk deals really need to go away, and there needs to be an opportunity for meaningful ownership. And so we started with that in mind. And so if you look at the athlete use case, they may start as an accredited investor, and they may be able to write larger size checks, but then, not all athletes choose when to be done with sport. So if you think about it, they get injured, they get cut, they may slide all the way to a retail investor status. And then here we are at the same spot as the average Joe, right? So you think of, let's say, a mom or dad who has two kids, they're paying into sport, they're buying the high ticket items to, $3,500 for goalie pads to, a very expensive baseball bat. There's not meaningful ownership there. And so we said, all right, we got to be able to design something that caters to the masses, that all for all, that really kind of transcends the investor types. And so we looked at doing a 2 and 20 fund. We're like, no, we can't do that. We don't want to lock up capital for 5 or 10 years. We also we want to be equally yoked with our investors. So we shouldn't do a 2% management fee and 20% carry. We want so that we all make money at the same time as our investors. So we scrapped that idea. We looked at kind of the legislation changes, and this was really kind of the pre-COVID through post-COVID design. So kind of letting this, really get to this point. And it wasn't until we kept going through this and iterating over and over, say, all right, not a 220, gotta have it so that retail investors can come in. All right, if we do retail investors, it's got to be less risk deals for growth stage companies. So identifying all that over time got us to the point where we're like, this is it. And so what we created is really it's actually the first evergreen firm in sports. And with that, we do it through a vertically integrated holding company. And so that holding company allows us to basically push investments across the asset class, kind of like what Kyle was saying. So everything from teams, leagues, to then the downstream pieces, the spot that people don't think of. So what's happening with ticketing? What's happening with food and bev? What's happening with all the ancillary products that run alongside the team? And that's the sweet spot for growth stage companies that we want to invest in. So we literally take that and go down the line and say, all right, here's what we're investing in. Here's our thesis. And so finally, we also created kind of a sidecar 40 Act fund, an evergreen fund that sits alongside our holding company so that retail investors can invest in that vehicle and our accredited investors can be in the holding company. So literally a ubiquitous vehicle that all comes to the same spot for the sports assets.
That's really unique and interesting. Yeah, because obviously the 40X space has different nuances where both Mike and I've come from in the past. But how you put the two together to kind of fit the best of both worlds, as you mentioned. And then obviously going after the sports industry, which is, your point, is really been closed off from an access point of view for many. I think it's really cool.
Yeah, thank you. Yeah, it's been interesting finding this. And, the 40 Act allows us to have the retail investors come alongside. And frankly, having it this way makes it so then our credit investors, because, as you can imagine, the SEC wants parity, right? Everybody's got to be treated the exact same. Somebody who writes a $5 million check really wants to have different perks than somebody who's writing a $500 check, right? So to mix those two together it's a hard feat, but what it makes it so that in our holding company vehicle, we own the RAA that charges the management fees to the interval fund, to that 40 Act fund. And then we own all the shares that actually create distributions to the holding company. So we have that way to make it so that it's a different share class and it's owning the vehicle that's making it happen versus just investing in the vehicle itself.
Very interesting. That's monthly liquidity, quarterly liquidity, monthly NAV?
Yeah. So two things. So again, thinking of that athlete, retail investor, it's something they need liquidity fast. So we have a secondaries ATS that allows people to have daily liquidity, trade on demand. And then we also do redemption periods semi-annually. And so that makes it so they can change their entire position. So long as, they're first at the table under the cap that we have for the fund, they can change their entire position, liquidate their entire holdings anytime in those periods.
Oh, that's amazing. That's great.
Yeah. Very cool. Let's turn the corner here. We're starting into the fun stuff. Tell us about what's like the history of sports investing. So like, what I see, or, what I've perceived over the last, 100 years, is a lot of like, family operated sports franchises for the most part. Kind of what's like the history of sports investing? Kind of take us through that.
It's still that way. So, what's interesting, you hit it spot on, because it's a bunch of families, and they're good families. They're good people that do it. But it's a select few people who can own in the sports franchises. And to your point, everybody thinks of sports franchises. They don't think of everything else that's connected to the sports asset class. So, people think the teams, they think the leagues. The fun fact is the teams and leagues do not print money. The valuations continue to go up, but what makes money is the media and broadcasting, the ticketing, the food and bev, the sport tech, these CPG products, the devices that are alongside it that actually make the sports happen. And so we don't even really, so we do look at some of the teams, but we look at it as a foot in the door in a minority position to get us the rest of the stream. So for instance, we're looking at a European soccer team right now. And although that's great, we're looking at the team, we want to see improvements in the team. We're looking at the real estate, the stadium. Can we put a digital wallet in there? Can we connect it to American products? And so we're looking at all those pieces. So if you follow a digital footprint of the dollar and see where that goes in the propensity of the market, that's where we invest our dollars. And so that's kind of where you look at the history of sports investing. Nobody has been on that side of it because all of those pieces have traditionally been privately held, right? So the public side of it, and recently, you have some big name firms that are investing in minority stakes in the teams. What they're doing is they're going hunting and looking at the top teams and say, hey, we want to provide some liquidity. We want to have you take some chips off the table. And they're offering to buy those out at the high valuations. Well, then you need an exit event to make money on those versus we're going to go after the privately held pieces. And then from there, we can actually take those, provide liquidity for the founders and watch those suckers scale on the net asset value. So it's a stock appreciation play. And so what that means is we can play with where sports have been against the markets. And so sports in general has outperformed the markets for the last 60 years. And in the last 20, you've seen it more so on the team side. But just as a stable asset class, it's recession-proof, it's resilient, because generally, we've seen it with COVID, we saw it in 2008, sure. The markets and everything could be tanking, but people are still going to fill the stands. Or in COVID, when you couldn't be in stands, memorabilia sales are through the roof. So it continues to be one of these asset classes that unites everybody, and people still pour cash into year over year.
That's really cool. And I'm just curious, what was the feedback as you guys kind of started this journey, going to your network and saying, here, this is what we're going to do. We're going to kind of democratize the space, give people access.
The feedback was, I don't understand what you're doing.
Okay.
And it's still it. And we still get that all the time, right? Because what we're doing hasn't been done before. Right. So what do you mean I want to own? Yeah, I want to own a team. I can't own a team. I can't write a big enough check to own the team. Right. Well, we can write a big enough check for you. You're just a part of it. Right. Yeah. So this model that we've built exists in other industries, right? Real estate's a big one. You see all these companies raising capital from 1 million people to go buy an apartment complex, right? Same thing. We're just doing it in sports. The second thing is obviously with all the different verticals we've set up with the Holdco as a C Corp, we're essentially a firm that owns a bunch of different funds, and then trying to explain all the different funds, real estate, right? Sports tech, sports med, 220, like Evergreen Fund, Management Co., explaining all of that. And then each one of those funds having their own parameters for investment and criteria and all this, that gets really, even with the most sophisticated investors, it's a mouthful. So we've actually spent a lot of time trying to just simplify what we're doing and trying to explain it as we're just a sports firm that is investing in sports opportunities, right?
Yeah.
If you want to get in, like, hey, we want to do real estate. Great, you can. Just in here, real estate's part of what we do and dumb it down that way. So that's been, I would argue, that's been the hardest part, is trying to explain to people what we do and understand that like everything is as by the book as you could possibly get. Some people don't know what a 40 Act fund is. I'm glad you guys do. A lot of people don't.
Yeah.
So then we have to explain that, and they're like, "Oh, is this legal?" Like, yeah, this is the Wolf of Wall Street, right? So, so a lot of those, right? New fund managers, new structure, new access, everything that we're doing is new. So then putting it all together and then presenting it to educated, sophisticated investors, and sometimes new is really exciting, but sometimes new comes with a lot of red flags, and it's overcoming those obstacles and red flags to be like, no, this is all by the book, legit, and all that. That's been, I would argue, probably our biggest obstacle.
Oddly enough, what Kyle said was pretty interesting. I was early on in our days designing this. I sat down with an investor and I said, what are the pain points that you're experiencing? He's like, oh my gosh, I hate a 20% tax on my money when it's my money and that's going right to the GP estates. Like, okay, what else? He's like, oh my gosh, like, if I have a 10-year lockup, it's completely liquid. He's like, I've borrowed against it. I need to do something different. And so then I explained what we do. And I'm like, it's the exact opposite. And he looked at me, he goes, so how do you make money? You don't have a 2 and 20? And I told him again, he's like, I don't know. I'm like, I literally just gave you exactly what you said you don't like. And now you're still meeting the problem. So it's funny, you got to meet the market where it's at. But luckily, to Kyle's point again, is we're kind of on this precipice where the new things are coming. Like I'll say, kudos to like a group like Arctos, which is a behemoth. And they've obviously opened up the sports asset class and buying into teams. And so people are now starting to pay attention to sports asset class. So the retail investors, the people who may be a little bit more gun shy, are now gung ho to get in.
Yeah. And you talked about a couple like interesting opportunities. You mentioned like real estate, a couple other things. What are some of the opportunities you've seen so far? Like what are some of the things that really excite you here?
I'll put it this way. Have you guys, either of you been to the Battery in Atlanta?
Don't believe so.
Been there?
No.
Let's see. Have you been to where the San Francisco Giants play up there? Have you seen any of those stadiums or complexes? Have you been to Have you been to Frisco, the Star, down where the Cowboys practice facility?
Yeah.
Well, long story short, and actually it just came out, the Mets right now are looking to build a big entertainment complex around Citi Field, right? So essentially that's the model. That's where sports is going, whether it's professional sports or even universities. We've had multiple universities reach out about building out entertainment sports complexes around there. They have stadiums. Stadiums just sit there by themselves. They're empty. Right. And they want to turn it into an experience with the technology, with all the media. These teams, leagues want to turn their single stadium into this whole metropolis around the events at the stadium, because it's not just the sports. Right. So like the Atlanta Braves, owned by Liberty Media, it's a publicly traded company. Right. But they don't just own the Braves. What people don't realize is they own the entire Battery. And for those of you who have not been to Atlanta, the Battery is an entire, I don't know, 1,000 acres right outside of Atlanta. That they have there's all the food and beverage in the stadium. Right outside, there's probably 20 bars and restaurants, 25, 30. There's the Omni Hotel. There's the Comcast Central headquarters, which It's a massive building right there. There's apartment complexes over all of the food and beverage restaurants. There's a movie theater. There's retail stores. There's parking. There's Tyson Krupp elevators right across the street. There's all these retail, like big corporate.
Yeah.
The Braves own all of that.
Yeah.
Right?
Cool.
They own the infrastructure. They own the parking. They own the technology. They own the internet. They own all the wires, all the security. Everything in that complex pays the Braves to be there.
This is, as you're talking about, I'm thinking about like Wrigley. Wrigleyville is the same thing. It's
perfect. Yeah. So today it's February. The Braves are off season. The Battery is printing money. The Braves are making money. People are paying rent. Comcast signed a big term lease. The Omni Hotel. They're making money year round, whether the team is playing or not. That is essentially what we've created at CVP, just from a fun side. So we want to buy and own sports teams around the world. We want to take a majority stake or a significant enough stake in those teams where we can have economic rights to those teams. Then we want to take our 20, 30, 40 portfolio companies and loop them into that ecosystem. So if we have a ticketing company, a food and beverage company, we have a company that does facilities. So plumbing, HVAC, ice machines, you don't think about that stuff. That is repeat monthly recurring revenue year round 24/7. Everybody needs air filters changed out every 3 months, right? Every 2 months, right? Every stadium needs faucets, toilets, sinks, like something that simple. That's how these big teams are making money, because the owners, as you guys mentioned, they're a family owner. They've owned the team for 40 years. Well, they haven't sold the team. They haven't sold any equity in the team. So how do they make money, right? They own all the aspects of, other than the valuation stock going up, maybe they take a loan against it. They own all the aspects around the stadium, and that's how they're printing cash and how they keep making more and more money. We're doing the same thing just as a fund. So we're going to own 30, 40, 50 portfolio companies and be able to take those portfolio companies into the sports team we own, whether they're a later stage company that's ready to deploy stadium-wide or part of our startup studio where, hey, we're going to try this at this team and see if it works and see what doesn't work. We have the full capabilities to all of it because of our management team, the different level of investments, and the ownership positions that we're going to take across the different sports teams, different level of teams, different sports, male, female, collegiate, professional, Europe, American, we don't care.
And what's interesting too is if you zoom out at like a 30,000-foot view, we're at this really interesting period of convergence between fan experience and team experience. So what are the athletes experiencing and what are the fans experiencing? And those two things are coming together, because it used to be very much in silos. So if you think the post-COVID social media revolution of how everything is turning more and deeper into a fan engagement, how you can be with the team, how you can experience it differently in your home, virtually, it's all coming together. And so that's making this combination of, I would say, traditionally different aspects of the sport experience and different silos of it all come together, which is wild.
Yeah, that's really cool. I'm curious on the deal flow side from, obviously you guys are in the space. I'm sure you see a lot going on from acquisition or negotiation to acquisition to deployment in your fund. What's the timeline look like? I mean, obviously everything is different deal by deal, but I'm just curious, based on these conversations you're having in real time, what is that?
It depends. It depends on where the company stands, if they have all the right information we need.
Okay.
A lot of people don't have. We've had companies that came to us and the company's great. I'm like, can you send us the data room? And they're like, we don't have one ready yet.
Yeah.
Okay. Well, when you get all that ready, which is going to take you a month, then we can revisit it. People who do have everything, all the financials, documents, everything ready to go, it could take 30 days. We're ready to deploy. If the company fits the mold, every box is checked. We've done our homework. We have a full diligence team. If it fits the mold, if they want to work with us, we want to work with them. We can bring value. We can grow and scale that company. Our key metrics are profitability, growth stage, revenue generating companies. That's what we want. If they hit those main three metrics, give or take, we'll talk to you, right? Deal flow is not a problem. We have hundreds of leads coming in every single day. I think we're in a really good spot because I would say the venture market, the private equity market over the last, call it 2 years, has been really tough for founders.
Yeah.
So we're able to be in a position of negotiation when we have capital. We have capital, you need capital. let's get a little bit better deal on the table here, right? So we can strategically negotiate a discount or a better valuation on our end to give us a better piece of the pie. We also have our entire management team, which is extremely powerful. The founder of Amazon Alexa is our CTO. We have our CSO, Jamil, is from the NFL, Major League Soccer front office for 10 years. We have Brian, who ran sports entertainment for Amazon for 8 years. Alexa was the third largest private marketing firm in the country. They do $400 million a year in ad spend. Like, that's our management team. So if we invest in a company, we deploy that whole team into that company. So we also will argue you don't need as much capital as you think, because you're going to get our team. So instead of us having to give you $5 million and you're going to go spend $4 million on hiring people, maybe we only need to give you $2 million and we're going to give you $2 million worth of services through our management co-team that's going to help grow and scale you 10x better than you could ever afford. And that's part of our model, right? That's how we reduce our risk as an investment. That's how we get a return for our shareholders across the board. And we're also, our management co-team is part of the diligence team. So once we get the deal done, we already know where their strengths and weaknesses are. It's not like we're going into this, cold and having to start from day one. As soon as we deploy and we got our deal done, we are off to the races and we're growing and scaling companies very quickly.
And what's interesting too is, if you look at this, a traditional VC, the word value add VC gets used and abused like you wouldn't believe in this industry. And there's far too many charlatans out there that don't actually live by it. I would say the reason why we actually look at value add differently is because we are that patient long-term capital. So I'll tell you, if the founder comes to me day one, they're like, yeah, I'm going to sell this. I already have something in hand. I'm going to exit in 2 years and be $1 billion company. I'm be like, good for you. I'm not going to invest. Well, good for you. I have no interest in having that, because we provide returns to our LPs through stock appreciation. Does a $1 billion exit help? Sure. We can redeploy that into capital. Absolutely. But depending on where we're at, kind of on that investment ecosystem, we can see bigger returns for our LPs if we can get in earlier, deploy the management team, and then have patient capital and let them over the next 4 years see, 25% growth year over year over year. Plus, that's way more valuable to us than somebody who's doing a moonshot. We're not an ecosystem that's banking on 1 in 10 to return the fund. I want all 10 to be wildly profitable companies and add to our bottom line.
The sports landscape, obviously we've talked about NFL, MLB, some of these big sports leagues that everyone's familiar with. What are you guys looking at any, maybe like smaller up and coming, obviously like there's esports now, there's I don't know, paintball. What do you guys?
Probably not obscure ones. I mean, I like paintball and I like playing it, but there has to be a critical mass, and I'm not talking like a total adjustable market. Again, another thing that gets used and abused. For me, it's more so if you again follow how sports makes money, right? It's the viewership, it's the media broadcasting right, and then all the ancillary services. So if this is a microcosm where you're creating a brand new sport, it's going to be really hard for us to engage. And the other side of it is we're a growth stage investor. So we want to provide capital to folks that are like, hey, I'm buying out a competitor, or I'm in 3 different stadiums. I need to scale to 10, right? So we're providing growth capital that gets them through that next inflection point so they can be $1 billion company. So, the emerging teams and leagues, I will just say this flat out, at the risk of, torpedoing myself, I think we're with some sports areas, we're kind of already seeing it be frothy, right? We're already seeing some of that, depending on what's happening in some sports. There's everything from like professional bull riding to women's sports to NWSL. Some of the valuations are ludicrous and some are actually really attractive. So it really just depends on where it's at. And again, the ecosystem surrounding it.
Yeah. You said something really interesting, Nick, earlier about just following the fan experience and how that's converging, which I thought was pretty cool to understand, because, obviously as you follow that, you're probably going to see different opportunities uncovering themselves or opening up to you guys in real time, right?
100%. Yeah. Like for me, as much as I like to actually, I'm going to steal from you, Mike, as much as I like to play paintball in the summer, it's probably not a investment ready vehicle. It probably makes a lot of money, but not investment ready.
Yeah. And we want stuff. One that we've looked at and we've talked about is like professional bull riding. Yeah. Right. And people kind of laugh at that, but if you ever gone, they sell out
rodeos
stadiums.
are huge.
Right. It's a big international, especially in South America. And so you're getting the stadium sellout, TV deals, sponsors, ticket sales, parking, right? Technology, everything that we look for, something like that. They're raising capital to expand and grow and scale new venues and all that. It's really low key. It's not the NFL. It's not some big, big five sport, but they print money if you do it the right way, and you have your hands in a lot of different verticals inside of their organization. It'll have a very nice return, and they're growing at a rapid rate, right? NWSL is another one, National Women's Soccer League. We love that. I would argue that some of their valuations are way too high. Some individual teams are worth 5 times more than the entire league broadcast contract. So I would raise some questions there. Yes, the stadiums and the venues add value, but there's some questions there, which is why we're liking some of the European opportunities right now that have significantly lower valuations compared to the multi-billion-dollar broadcast contract, right? So there's a lot of factors in play when you look at value. Yes, is NWSL great? That's awesome. Is WNBA great? I wish I had WNBA 5 years ago, not today, right? Yeah. WNBA 5 years ago would have been a great investment. Today, I would say things need to fizzle. The smoke or the heat needs to fizzle out a little bit, right? With the Caitlin Clark stuff, the ratings are out of the roof. See if they can maintain all that before you really go, because our standard stock, right? You don't buy high, you buy on the dips and buy lows, right? So, it's the same thing. You just have to find the right fit, and we have a lot of deal flow, probably more than we anticipated we would get. So we have the ability to be a little bit picky when it comes to some of these opportunities.
Yeah, that makes a lot of sense. I'm curious too, what interesting trends are you guys seeing maybe in 2025 as you're moving forward throughout this year? Or as you're seeing all these deals coming in real time, is there any type of correlation or certain areas you're just like, okay, this is definitely cool. Let's go after these deals. Let's maybe put these on hold for now. What are your thoughts there?
I'll say the elephant in the room. AI is important. Shocker. Yeah. Companies integrating with AI, using AI. The great thing is we have 2 extremely high-level tech experts on our team that are above and beyond anything I could ever imagine in the tech space with AI. So not much gets past us, but when we have a company that they see and do the homework and go do the diligence on the tech, and they're like, when that box is checked, we start really focusing on it. So I think of AI as money. AI is a tool, right? If you're any business, if you're any startup and you're not using AI, it's the same thing. I listen to a lot of Gary Vaynerchuk from time to time, and he says AI today is for the people who didn't want to go do social media 15 years ago, and the people before that who didn't want to switch to using Gmail and emails. They wanted to keep writing letters, right? And the problem with AI is it's not going to be 5-10 years you're going to get left behind. In two years you're going to be left behind. So if you're not using AI in your business, even simple things from projections, accounting, marketing, I mean, there's so many things you could be doing with technology at every level of your business. If you're not using that to be more operationally efficient, you're probably going to lose in some capacity, or someone's just going to pass you. So I think that's a big trend. Every vertical, whether it's sports medicine, whether it's ticketing, whether it's real estate, you name it. If you're not using AI to do data analysis of the market and the industry and comparables and all that, it's right there in front of you. I would say that's the big one. And then for me, I would just say, and I don't want to say, I hate saying this term product market fit. I'm not a fan of that per se. I think that we want to see products that the market is telling us and them that there's a need for this, right? And so I see people that are raised all this capital and they have all these projections and all this, and I'm like, well, how many units have you sold? Well, not many. The market, you might be a great founder. You might say you have a product market fit. The market does a lot of the talking for people. And if they've been in business for years and years, and they've been in business for 5-10 years, and they've raised all this capital, they've raised $5 million. We want to raise another $3 million, and we're in a great spot, and we've been around for 7 years. How much revenue do you have? $200,000. Obviously, the market is telling you that either A, they're not there, or B, You have a different model. You went the Chat GPT route, and you have 5 million users that you haven't charged yet, and you're ready to go.
Yeah.
Usually
Market
that's
never lies.
right. So if they don't have either the market telling them or the market paying them for their services, that's also a red flag. And you see a lot of companies that evolved because of COVID in 2020, 21 that are 3-4 years old that were really great then for about 6 months. And since then, the market has said, probably not. We're already on to the next thing. And they haven't adopted or changed their model or their focus or their product or their tech. And the market is already down the road. So those would be the very consistent trends that I see. Those would probably be the two biggest ones.
I would say Kyle's spot on with 100% of that. And I think those are kind of as Kyle said, the elephant in the room ones that we're seeing a lot of in submissions. I think if we go back to a core thesis of innovation, I think what's really interesting, I had a really good mentor in my life when I was a young kid. And he said to me, Nick, you want to know how to innovate? He said, all you need to do is look at what the top 1% in the world consume. And that's what's going to be available to the masses years down the road. He said, look at what happened with everybody wanted a private driver when they got older. Oh my gosh, I'm so rich, I can have a private driver. Well, yeah, now you have Uber. You can have it anytime. Or, oh my gosh, when I'm wealthy someday, I don't want to have, a phone attached to a phone. Well, now we have cell phones, like it's a trend that continues to grow. So what we do is we look to what are people experiencing and then where do we take it down? So AI is a big factor, a tool that's making that happen. But look at the transformation inside of stadiums, right? What do people want? They want to feel like it's exclusive. It goes back to the fan experience. Well, now we have on-field suites, right? We have couches and suites. We have in-seat food and bev to anywhere inside the stadium. You have a digital footprint that follows you inside the stadium. So that experience is going to continue to evolve and change. So I would say if people are out there innovating and they want to see the next wave in sports about kind of revealing some of the things we're looking at, is look at what the people who are quote unquote the elite are using and wait for that to get replicated to the masses. Find a way to make a 1% difference and make it so that it is affordable to the masses and scale it. And that's exactly what we invest in.
That's awesome.
Yeah.
I love that.
Yeah. Really cool way to think about it. You mentioned you guys are seeing a lot of deal flow. Talk to us. How's the deal flow finding you guys?
Man, we have inbound more than we can shake a stick at. I mean, it is, and I don't mean this in an egotistical way, but the fact that like we are extremely piped into the sports ecosystem, we have people knocking on our doors constantly. So whether that's they come to us because of sports tech and they know that we have the person who literally invented Amazon Alexa, or we have somebody who specialized in the MLS and NFL front office and he knows everybody and their dog, so therefore they're coming to us. Or, you even get big names, Super Bowl winners in an organization. They're like, well, if this guy's connected to this team, he can get me into that stadium, right? So we have a constant flow of deals just because of our presence. And again, I don't mean that in an egotistical way. It's one of those when you build a team, this isn't Field of Dreams where you build it and they will come. But when you put a critical mass of people together that cause change in the industry, people pay attention. They want to gravitate towards that.
And our marketing team is badass, and our website and PR stuff is really good. So we get a lot of random outreach on our website for people we don't know where they came from, but they found our website somewhere and they send us an inquiry for whatever they're trying to pitch us on. So we probably get 1 or 2 a day. I get them all, and we have hundreds of them over the past year. So yeah, that's about right.
Yeah. How do you go about sifting through the noise?
Yeah, all the companies. Which ones do we eliminate? Yeah, we have metrics, right? So we have questions. Our marketing team can sift through some of the questions, and they have to hit certain categories and questions, and then we go to our diligence team. And again, not all of it's noise as much as people think, because we have so many different verticals inside of our fund, right? So we do have a startup studio that might invest in and bring in a early stage pre-revenue company, right? And we also might have a vertical that only wants Series B and Series C companies that are doing 50 to 100 million in revenue. So we have a wide range, and then depending on where that company fits from a size or revenue standpoint, we then pass that off to that team for them to do some initial diligence. Are they interested? Are they not interested? And then we go from there. So we have a slight funnel, but it's not as narrow as people would think, because we have so many different verticals and we have a pretty good team across the board and a pretty big team, as well as we also have, AI available to us. We use AI also, because we would be pot calling the kettle black here if we didn't. You could take a full, we could take that spreadsheet that they submit to us and all the bullet points and put it in and say, where does this company fit and what can it do and where should it go and what should we look at this, yada yada. So it takes 2 minutes to narrow that down if we need to get to that route as well.
The AI side filters out the lion's share of everything, and we truly, like Kyle said, have a system and a platform that really takes from like seed through IPO, so that we can invest across the whole ecosystem, the whole spectrum. But AI is going to weed out a lot. And a lot of it comes down to basically two things. One is revenue quality. And I mean quality over quantity. Just because you make 150 million in revenue, but it turns out you have one contract that's giving you 150 million because your brother owns this team, is not quality revenue. The day that ends, you're done. It's the death of your company, right? So revenue quality. And then the other one is honestly the founders. Like, one of the biggest reasons we place or don't place is actually talk with the founders. Because again, we're patient capital. This is a marriage. We're in there for long term. We need to look at this of what's it going to look like to be with this person 10 years from now. And frankly, if they can't get along with our ecosystem, you're gone. Like, it's just not going to work. Like, we want it so that we can be equally yoked and have a lot of fun and bring good people in the system. So strict no a-holes policy. So if they come across statistical, it's just not going to work.
I would say we operate like a locker room. We're all athletes. We're all former athletes. And if you can fit in our locker room, we'll welcome you in. And if you're going to if you're going to be a cancer to our locker room and our culture, then no bueno.
I love that approach. What's just curious too, what's the goal for the CDP season this year? Like, where do you guys want to be? 2025?
We want to finish our $500 million raise right now. I want to finish it by tomorrow. We might come short tomorrow, but we have pretty ambitious goals. We got some pretty big fish on the hook to come in on that round. I don't know if I'm allowed to say that, but Nick will tell you if I can or can't. And then we already have 2 deployments done. We have about 4 or 5 others in the works. We want to get our first team deal done in the next 90 days. We want to wrap up our first acquisition of a team. We want to have 5 or 6 companies under the wraps as well in the next probably 90. Let's call it by the end of quarter 2, just for shits and giggles. And then we want to just keep finding good opportunities and become a recognizable name in the industry. I think we've spent a lot of time going about doing this the right way, building a company culture across the board with our whole team. And we want that, make sure that echoes through the companies we invest in, the teams we invest in, the people we interact with, because we take personal pride in this. We're all personally invested in this. The reason why we're not running a 220 fund, we don't get paid unless the fund is successful. We don't make money unless this fund is successful. So we are just as Nick will say, we're equally as yoked as our shareholders. And so we all have a lot riding on this. So there's only one way to do it, and it's the right way. We can't take shortcuts. We're not messing around. We can't mess around with compliance. We're putting ourselves, our shareholders, and our portfolio companies all in a very good position to be successful. And it requires a lot of work, a lot of time, a lot of patience, but it also requires the right people and the right team, and I think we have that.
CVP will be $1 billion assets under management by the end of 2026 or earlier, and will be known as the largest retail investor-friendly sports firm in the country. Period.
Yeah, that's awesome, man.
Great.
And then how is tell us about the fundraising process. How's it been for you? What's the market like? High level.
It's surprisingly good though because of the market. It's one of those where everybody has probably a different opinion about that, depending on which sector you're in of this industry. I would say for us, getting through the initial hurdle of what do you do and how does this work? I think once we bypass that, now that we really have grown as a firm, it's nothing but smiles and receptivity. It's been kind of refreshing. We had a big event down in New Orleans during the Super Bowl, and it was ear to ear grins the entire time. Like, people are thrilled about what we're doing, what we're unlocking. So I think we've turned the corner. So the fundraising process has definitely had its ups and downs because of the market, but luckily we're in an ecosystem and an industry that's pretty recession proof.
I'm going to read you verbatim my LinkedIn post from this morning. It opens up with, raising capital sucks. Raising capital is fun. Literally, it's literally, you can go to my LinkedIn and see it. And I think that's it. It's, and it goes into the details, right? And every founder deals with this, funds deal with it. You have those really high moments where you get that big check-in. Yeah. You get those tough moments where an investor pulls out or doesn't fund or defaults on their whatever, or doesn't go through. We all deal with it. Funds deal with it just as much as startups deal with it, and founders raising capital. You deal with the drag along. You deal with, it's money's coming. And then all of a sudden those people just disappear. Right. So it's the same. It's in my mind, it goes back. It's selling. It's sales. Right. Sure. It's the same many sales. The more games you play, the more phone numbers you dial, the better chance you have. It's a numbers game. We have a really good network where we've maximized that network. We've reached out to people. We've connected with people. We've got some really exciting LPs and GPs in our fund. We have some big time athletes in our fund that we may or may not be able to name down the road. So we've got a lot of traction from a lot of the right people. We've obviously had some hiccups along the way, but that's part of it, right? That's part of athletes. That's part of adversity. That's part of what we're doing. It's the nature of the business. And we're in a really good spot right now where we've already started deploying capital. We have some big check writers coming in. We had a great week in New Orleans with a lot of traction, a lot of visibility. And we couldn't be in a better spot, again, especially with how the market's gone over the last year and a half, to be able to raise nine plus figures of capital over the last 18 months in the market, election year, all that kind of stuff. I'd pat ourselves on the back a little there, but we're not even close to where we want to be, and we're just getting started.
I don't stand on ceremony. We're going to keep sprinting.
Yeah,
that's great.
Cool.
And if you're listening to this, we got room.
Give them a call. Check the description.
Call now, 1-800 buy one get one free. Ends in 3 minutes. But no, we're looking for good partners. We're looking for good investors. We're looking for medium checks, small checks. We'll have the retail portal open here. We launched the Evergreen Fund, so we'll have the retail side of things launched in the next 60 days, where anybody can come in. You could write $1,000 check and be a part of our fund. You could write a $100 million check and be part of our fund. Anywhere in between. If you want to go more than 100 million, we can take that too. Not limited. We have no cap. And we're not going to close this and go to the next fund. We're going to keep running this thing, building this thing out. Hopefully go to $5, $10, $15 billion fund with assets under management in the next 10 years. And all of our shareholders and LPs will be extremely happy, and we'll have some really cool projects. And then all of our LPs and shareholders will get invited to those. They'll be able to go to those games, know they have a piece of those teams, experience it as an owner. It's all there. It's pretty exciting.
That's really cool. Yeah,
I love it. I think that's a great note to start wrapping up here. Kyle, Nick, this has been a lot of fun. We've been excited for this one for a while, so appreciate you guys joining us. Where could people go to connect with you guys and learn more about CVP?
.com is the website. I would also check out, if you have LinkedIn, you can check out our pages on LinkedIn. Our whole team is pretty active on LinkedIn as well. But the website is a great way to go read. We also have our management co. So championmanagementco.com is our management company as well. So all of the offerings we provide to our teams and outside. We don't just work with our portfolio companies. We have external companies that hire us as well. So similar to a KPMG model, we have a full services division that works with all sorts of companies and sports teams that hire us for outside services. But those are our websites. LinkedIn is also on there. And then you can get a hold of us if you want to get on our wait list for the Evergreen Fund to get a piece as a retail investor. We have a wait list started, so you can put your name and info there. And then when we're up and running, you'll be able to join it. And it'll run just like any trading app. So you'll have an app, you can download it. You can see your portfolio on your phone, similar to looking at your 401k. You'll be able to see what positions you have, what your equity is doing, what the return is. You'll be able to see all of that right on your app, just like any trading platform or 401k platform that you would have.
That's really cool. This has been an exciting conversation, guys, and we'll make sure to include all that info, your contact info in the show notes there. This has been really fun conversation.